Imagine a world where your investments don't just grow your wealth, but actively shape the future of our planet. Now, here's a surprising truth. Most green portfolios aren't actually outperforming the market, but a select few, well, they're making billions. By the end of this deep dive, you'll not only understand where a mind-boggling $2.5 trillion is poised to flow just to protect our communities, but you'll also unlock a strategic playbook for 2025. You'll know something many investors are still just waking up to, how savvy players are finding these hidden opportunities and even crucial downside protection in this rapidly evolving world of sustainable finance. Okay, let's unpack this a bit. You know that feeling in the investment world, right? When you're presented with just countless sustainable funds or green initiative, it can be really hard to figure out what's truly impactful and what's maybe just clever marketing. It often feels like this dizzying array of options, all with conflicting claims. But today, we're cutting through that noise. We want to show you what truly matters in advanced sustainable investing.
Exactly. Our mission today is precisely that, to really take a deep dive into the latest sources on advanced sustainable investing in 2025. We'll pull out the crucial nuggets of knowledge, help you understand where this cutting-edge finance and our planet's future genuinely intersect. And, importantly, how you can be truly well-informed in what's becoming a critical and, frankly, increasingly complex field.
What's really fascinating looking at these sources is just how quickly the landscape is shifting. It's moving beyond what many might, traditionally think of as sustainable investing. If you thought it was just about solar panels or maybe avoiding certain industries, well, you're probably looking at an outdated map. The real capital, these structural themes redefining portfolios in 2025, they're far more diverse, more nuanced. So what are these exciting new frontiers? How are they actually reshaping investment strategies?
Well, what's truly fascinating here is how capital is now flowing quite strategically into five distinct structural themes. Each one is addressing diverse and pretty pressing environmental and social challenges. First up, we have climate adaptation and resilience. This is a huge area now. With extreme weather events escalating globally, investments are critically needed in areas that help societies cope and, well, bounce back. Think water management, advanced catastrophe insurance models, sustainable agriculture practices.
Okay, so less about preventing climate change, more about dealing with its effects.
Precisely. We're talking about developing resilience-focused bonds, infrastructure funds. The idea isn't just to avoid climate risk, but actively to hedge against its impacts, to build capacity. For instance, you see these innovative water management bonds emerging in places like India.
Water management bonds, how do those actually work? Are they complex?
They can be, yeah. They often involve pretty intricate structures, sometimes linking returns directly to specific environmental performance indicators, like, say, reduced water scarcity in a region, or improved water quality for a community. It offers a unique financial return profile, but also demonstrates clear, measurable, positive impact on local populations, on their assets. That makes them really attractive to impact-focused investors looking beyond just traditional risk-reward.
That's a really comprehensive breakdown for just the first theme. Are there any of these frontiers that, present a particularly steep learning curve or maybe a higher entry barrier for the average investor? Or maybe some that are surprisingly accessible?
That's a great question, and it definitely speaks to the advanced nature of this topic. Some, like those water management bonds we mentioned, they can be complex, given their bespoke structures, the local context, but others, they're becoming more accessible. You see specialized funds or ETFs popping up that consolidate these types of assets. The key really is understanding the underlying challenge and how the investment is genuinely addressing it, not just on the surface.
Right, makes sense. Okay, so moving on from resilience, what's the second frontier?
Second is nature and biodiversity. This is gaining significant momentum lately. It aligns with global initiatives like the Global Biodiversity Framework. Portfolios are increasingly allocating capital to ecosystem preservation. This includes everything from large-scale reforestation projects, investments in sustainable timber, even sophisticated nature-based carbon credits.
So investing in nature itself.
Essentially, yes. And savvy investors are positioning themselves ahead of critical European Union biodiversity disclosures, and also the Task Force on Nature-Related Financial Disclosures, the TNFD guidelines.
TNFD, like TCFD, but for nature.
Exactly like TCFD for climate. TNFD provides a framework for companies to report and act on nature-related risks and opportunities. So investors who understand these frameworks, they're better equipped to identify companies truly contributing to and maybe benefiting from nature preservation.
So it's not just about avoiding harm, like you said, but actively investing in preserving and even restoring natural systems. That feels like a critical shift. What's next on the list?
Our third theme, What may be more familiar is also rapidly evolving: electrification and clean energy. The low-carbon transition remains absolutely central, of course, but the focus has broadened quite a bit. Beyond traditional renewables like solar and wind farms, we're now talking electric vehicles, their entire supply chains, advanced battery storage, smart grids,
Ah, the whole ecosystem around
a
renewables.
whole ecosystem, exactly. Things needed to efficiently manage intermittent renewable power. These all benefit hugely from accelerating policy support worldwide. Investors should be looking for, say, thematic ETFs targeting the next generation of solar, wind, battery tech, and crucially, active managers who truly integrate rigorous carbon metrics into their stock selection process.
What does that mean, rigorous carbon metrics, beyond just saying a company is green?
It means looking beyond just the headline numbers. Understanding a company's entire emissions footprint, scope 1, 2, and 3, and assessing its credible transition plan, not just promises.
Got it. Okay, number 4.
Fourth is efficiency and circularity. Resource efficiency and these circular economy innovations are yielding both pretty compelling financial and environmental returns. This isn't just about reducing waste in the old sense. It's about fundamentally redesigning how we use resources.
Like turning waste into something valuable.
Precisely. Investment opportunities span things like industrial process optimization, green building retrofits that dramatically cut energy use, advanced recycling technologies, turning waste streams into valuable inputs. These efforts align closely with ambitious targets, like the EU Circular Economy Action Plan, which creates a supportive regulatory tailwind for growth.
That sounds like a fascinating area where innovation can lead directly to both cost savings and environmental benefits. Okay, and the final frontier.
And finally, number 5, emerging technologies. These are the high-potential, often early-stage allocations. We're talking areas like green hydrogen, advanced carbon capture, and next-generation battery solutions beyond lithium-ion.
The really cutting-edge stuff. Higher risk, maybe?
Definitely. These sectors require a more selective, risk-aware exposure, given they're still pretty nascent. But they benefit from growing corporate backing and substantial government investment through various incentives, research grants — these are the potential future growth engines — and identifying the leaders here. That requires deep sectoral expertise.
Wow. Okay. That's a truly expanded view of sustainable investing. 5 big frontiers. It's clear then it's not just about what you invest in, but really how you invest. Because here's a crucial truth, right? Simply investing in these themes, even these exciting ones, isn't enough to guarantee returns. You need to know how to pick the winners and, crucially, how to avoid the traps. Which brings us to a core challenge. We hear so much buzz about sustainable investing that it's the future. But do ESG portfolios always outperform? The answer might surprise you.
Yeah, this raises a really important question, especially for people moving into these more advanced strategies. Academic research, and there's a lot of it, consistently shows that individual companies with strong ESG profiles tend to deliver higher quality, superior financial performance. We're talking positive ESG corporate links in over 60% of studies and negative links in fewer than 10%.
Okay, so good ESG practices at a company level seem to correlate with being a better run company.
That seems to be the indication, yes.
Yeah.
It suggests strong ESG practices correlate with better management, better risk control. Yet here's the kicker: the portfolio level returns of average ESG strategies, particularly those that just use broad exclusions or basic screening, well, on average, they've been statistically indistinguishable from non-ESG benchmarks.
Indistinguishable, that's powerful. So just collecting ESG-friendly stocks isn't a guaranteed path to outperformance.
Exactly. It really highlights the undeniable need for active, alpha-oriented approaches rather than just passive exclusions or simple screening. It's about how you integrate ESG into the fundamental analysis, not just ticking boxes on a checklist.
Can you give an example of that, where active management made a real difference?
Absolutely. A prime case study that brings this to life is Robeco's Sustainable Global Stars equity strategy. They rigorously demonstrated and documented that a significant 22% of their excess returns between 2017 and 2022 was directly attributable to their deep ESG integration and their active management decisions based on that integration. This wasn't just market luck. It was about identifying companies where ESG strengths were genuinely driving better financial outcomes.
That 22% figure definitely makes a strong case for active management, but active management often comes with higher fees. So for listeners who might be wary, how do these strategies truly show they're delivering tangible alpha beyond just, well, marketing? And what should an investor look for to distinguish genuine ESG integration from maybe just greenwashing?
That's a critical point, absolutely. The key really is transparency and demonstrable impact. Genuine active managers will show you how ESG factors are integrated into their valuation models, their risk assessments, not just sprinkle ESG terms in their marketing materials.
So show the working, essentially.
Exactly. Look for managers who can point to specific investment decisions, buys or sells, where an ESG insight directly led to outperformance, or, crucially, risk avoidance. For example, shifting focus to fixed income strategies. Studies show that in 29% of cases, deep ESG analysis materially impacted outcomes. And here's the vital detail that many people miss. This impact was mostly through downside protection.
Downside protection. Okay, explain that a bit more.
It means it's not just about making more money when times are good, but strategically protecting your assets, reducing losses when the market gets volatile or turns down. That's a potential game changer for long-term investors. They're not just chasing the highest returns, they're building resilience into their portfolios by identifying hidden risks, environmental, social, governance risks that traditional financial analysis might overlook.
Okay, that makes a lot of sense. Building resilience, not just chasing upside. So if passive green maybe isn't cutting it on average, and active management with its focus on genuine integration and downside protection is key. What about the bigger global picture? How do we make sure this whole financial revolution benefits everyone, not just a select few? Especially when the rule book seems to keep changing in different parts of the world.
Yeah, the world of sustainable investing isn't one single unified market, is it? It feels more like a complex global chessboard with different rules, different players, massive opportunities, but also pitfalls. So how do we make sure this growth is truly inclusive? And what happens when regulations diverge so wildly? It creates this patchwork of expectations.
Well, if we connect this to the bigger picture, you're right. Inclusive finance, especially in emerging markets, is absolutely critical, both for impact and for opportunity. The IFC's Sustainable Banking and Finance Network SBFN paper, for instance, it strongly emphasizes targeting vulnerable populations. Why? To unlock an incredible estimated $2.5 trillion needed for climate adaptation projects in those regions alone. $2.5 trillion just for adaptation.
Just for adaptation. And this isn't just about altruism, right? It's smart strategic investment. We're talking about building resilient financial systems through sophisticated mechanisms, things like credit enhancements.
Where someone backs the loan to make it less risky.
Exactly. Or guarantees that reduce investor risk by promising to cover potential losses, and blend finance structures. These strategically combine concessional capital, like grants or low-interest loans, with commercial capital. The goal is to make projects in challenging markets financially viable and attractive enough for private investors to come in.
So kind of de-risking it for the private sector.
That's a good way to put it. These innovations open up frontier markets to sustainable capital. They drive real-world impact alongside financial returns. It's a bit like, an experienced navigator, understanding that different regions, maybe the complexity of Mumbai traffic versus LA traffic, both challenging, but each demand a unique set of skills and insights to thrive. Different context, different approach.
That analogy of the skilled navigator really highlights the complexity and the opportunity. It requires local knowledge, specific tools, but it's not just about these innovative financial structures, is it? It's also about that constantly shifting regulatory landscape investors have to deal with globally.
Absolutely. And 2025 looks like a major policy inflection point, creating significant divergence. Europe, for example, is refining its corporate sustainability reporting directive, the CSRD, and its taxonomy rules. This massively expands the scope and detail of sustainability reporting. It's driving greater transparency, comparability across companies.
So Europe's pushing for more data, more standardization.
Pretty much, yes. Moving towards a more standardized, transparent framework. Meanwhile, the U.S. is grappling with a pronounced ESG backlash. There's legal uncertainty, less unified federal guidance, varying state-level approaches, sometimes pushing in opposite directions.
So two very different paths emerging.
Increasingly distinct regulatory paths, yes. It's not just a minor difference. And add to that, global coordination on climate action seems to be waning a bit ahead of COP30. Only 22 countries updated their nationally determined contributions to their NDCs, those national climate plans, by the target deadline.
Not a great sign for global unity.
It makes things trickier. For investors, this divergence isn't just an inconvenience. It means you must adapt portfolios regionally. This could involve rebalancing between, say, assets aligned with strict EU disclosures versus those operating under evolving U.S. frameworks. You need to manage litigation risk, avoid greenwashing accusations which differ by region, and maybe even strategically capture regulatory arbitrage opportunities.
Arbitrage, like finding loopholes between the different rules.
Eventually, where different rules create temporary market inefficiencies or different valuations for similar activities. It's a high-stakes game, really, understanding which rules apply where and how to position yourself accordingly.
It definitely sounds like a high-stakes game, balancing global impact with local realities, ever-changing rulebooks. So what does this all mean for you, the listener? How can you cut through all this complexity and truly succeed in this dynamic environment? So pulling it all together,
Hmm.
what does this all mean, taking these different sources into account? As sustainable investing truly matures, becoming this sophisticated field, the sources make it crystal clear. Success really hinges on four key actions. Actions for any investor looking to make both a significant financial and an environmental difference.
Indeed. To truly thrive and contribute effectively in this space moving forward, you really need to 1. Align around those core themes. Actively seek out and deeply understand the next generation of opportunities. Resilience, biodiversity, next-gen clean energy, circularity, those emerging techs. Don't just follow the crowd, try to anticipate the next waves.
Okay, focus on the future themes.
2. Select active, impact-oriented managers. Look for those who genuinely generate alpha through deep, integrated ESG analysis. And crucially, can demonstrate how they're doing it, not just promise it. They should show clear evidence of both financial and impact returns.
Demand proof, not just promises. Got it.
3. Embrace inclusivity. Understand and leverage the power of deploying finance to underserved markets. Not just for social good, although that's important, but for the robust resilience and growth potential these markets offer when they're properly supported.
Look beyond the usual markets.
And 4, stay agile on regulation. Be prepared to navigate that significant and growing divergence across regions. This agility will be crucial to manage risk, ensure compliance, and yes, spot opportunities arising from differing policy landscapes.
Be adaptable. Those seem like four solid pillars. And as a little Easter egg for those of you listening closely, a nugget we touched on briefly but often gets overlooked. Remember that 29% figure for fixed income strategies, where ESG analysis materially impacted outcomes. The truly crucial detail here, the one that's easy to miss, is that this impact was mostly through downside protection. It's not just about chasing higher returns all the time. It's about strategically fortifying your assets when the market gets volatile. That's a fundamental game changer, turning potential losses into resilience. It's a strategic advantage many still miss in the broader conversation. Okay, let's quickly recap our deep dive into advanced sustainable investing in 2025. We explored those 5 new frontiers of green capital, from intricate water management bonds in India all the way to cutting-edge green hydrogen technologies. We uncovered the truth about returns. Passive often isn't enough. Active, alpha-oriented management, like Robeco's 22% excess returns example, is absolutely key, especially for that downside protection. And finally, we navigated that complex global chessboard, from unlocking potentially $2.5 trillion for climate adaptation in emerging markets through innovative finance to the wild divergence in regulations between, say, a transparent Europe and the evolving U.S. landscape.
Yeah, and given all these layers, the complexity, the opportunity, it really leaves us with a fundamental challenge to consider, doesn't it? In a world where climate action can feel increasingly fractured and financial landscapes are shifting constantly, almost minute by minute, how will you position your portfolio to not just weather the storm, but to actually thrive and actively contribute to building a truly resilient future?
That's a big question to ponder. And speaking of navigating complex, shifting landscapes, next time, we're diving into an entirely new set of sources. They reveal the shocking truth about digital identity in the age of AI. We'll uncover how your online self is being redefined as we speak, the hidden dangers lurking there, and also the incredible opportunities that are already here. Trust me, it's going to make you rethink everything you thought you knew about privacy and personal control online. You absolutely will not want to miss how these insights could reshape your digital life. See you then for the next deep dive.